every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis welcoming you to Money Talk on Monday the 15th of June. It's a holiday-shortened week in Hong Kong and China, with Friday a public holiday for Dragon Boat Day. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 90 million customers across 10 countries. In today's business and finance headlines, Pakistan's Prime Minister said a peace deal has been reached between the US and Iran. Both sides have declared the immediate and permanent termination of military operations on all fronts, including in Lebanon, Shehbaz Sharif says. Donald Trump says the deal with the Islamic Republic of Iran is now complete. He wrote on Truth Social, "Ships of the world, start your engines, let the oil flow." Iran's Deputy Foreign Minister confirmed that a deal with the US has been finalised and the official signing will happen in Switzerland on Friday. This week will be crowded with central bank decisions. The Fed will decide on its policy rate in Chairman Kevin Walsh's first meeting. The Bank of Japan is now increasingly expected to hike rates to slow the slide in the Japanese yen. Then the Reserve Bank of Australia is broadly expected to hold fire this week after 3 rate hikes since January. The Bank of England is expected to sit tight too, as softer inflation has bought policymakers some breathing room. In Asia, the central banks of Taiwan, Malaysia, Indonesia and the Philippines will meet this week. India's inflation accelerated to a 16-month high of 3.9% in May, driven by rising food prices and the knock-on effects of the Middle East war on energy and fertiliser costs, though the reading still came in slightly below market expectations and under the Reserve Bank of India's 4% target. Food inflation jumped to 4.8%, its fastest pace since early 2025. SpaceX shares surged in their historic Wall Street debut Friday, valuing Elon Musk's A-to-I to Rockets group at $2.1 trillion after the group raised $75 billion in the world's biggest initial public offering. The shares ended up by almost a fifth on Friday after listing on Thursday evening at $135. Trading activity was vigorous, with about $80 billion of shares trading hands, and SpaceX is now the world's 6th most valuable company. On today's programme, I'm joined by Mark Toe, Managing Director of Asset Management at the Fung Financial Group, and Carlos Casanova, Senior Asia Economist at Union Bancaire Privée. And providing a view from mainland China is Shanghai-based independent economist Andy Scher. Today's Asian business letter is also available. You'll find that at peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, US stocks and bonds extended their rallies Friday as fresh confirmation emerged that the US and Iran were nearing a deal to end their war. The S&P 500 closed up 0.5% at 7,431. The Nasdaq Composite added 0.33% to finish at 25,889. The Dow advanced 354 points, or 0.7%, to settle at 51,202. For the week, the S&P 500 added 0.6%, its 9th weekly gain in 10 weeks. The Nasdaq rose 0.7%. The Dow was also up 0.7% over the 5 trading sessions. The 10-year Treasury note yield was up 2 basis points at 4.44%, and the yield on the 2-year Treasury note rose 2 basis points to 4.09%. The dollar firmed after a 4-day run of losses. The US dollar index rose 0.1% to 99.81. Last week, the dollar was down by 0.33%. The Japanese yen weakened 0.2% to around 160.2 yen per dollar on Friday, as investors awaited the Bank of Japan's policy meeting this week, where it's widely expected to raise interest rates. And the offshore Chinese yuan firmed to around 6.76 renminbi per dollar, as investors assessed the latest inflation data and their implications for China's economic outlook. Spot gold settled 0.2% higher at $4,219 per ounce. However, bullion lost 2.5% last week. Oil prices fell to a near 3-month low. Brent crude oil futures were down 3.4% at $87.33 a barrel. Last week, Brent tumbled over 6%. And Bitcoin rebounded to $63,700, taking its gains for the week to 5.4%. Asian stock markets gained on Friday. The MSCI Asia Pacific Index advanced 2.8%, powered by a rally in South Korea's Kospi Index. The Kospi rose 4.6% to 8,124. For the week, the index was down 0.5%, but for 2026 so far, it has surged almost 93%. Japan's Nikkei 225 index gained 2.8% to close Friday at 66,020. It notched a weekly decline of 0.9%, but is still up over 31% year to date. And Taiwan's TAIEX, dominated by chipmaker TSMC, was up 2.4% for 2026. It's gained 52.5%. In Hong Kong, the Hang Seng Index rose 469 points, or 1.9%, to close at 24,718 on Friday. Year to date, the Hang Seng is down 3.6%, and on the mainland, the CSI 300 rose 1.2% to 4,777. It's up 3.2% so far this year. Futures markets in Japan pointing sharply higher this morning. Looks like the Nikkei 225 is going to gain around 2.5%. At the moment, it's indicating a flat open for the Hang Seng, but I'm sure that'll change as we get nearer the market opening points. You can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
We have some big headlines to discuss this morning, so let's get straight on with it. We have joining us first of all Mark Toe, who is Managing Director of Asset Management at the Fung Financial Group. Morning, Mark.
Good morning. Thanks for having me.
And also with us is Carlos Casanova, who is Senior Asia Economist at Union Bancaire Privé in Hong Kong. Morning, Carlos.
Good morning, Peter.
Now, as you heard there in the headlines, both the US and Pakistan and Iran are confirming a peace deal has been reached between the US and Iran. The details of what's actually been agreed are particularly scarce, but nevertheless, what I can tell you is we're getting some detail now from the Mehr news agency, which is a semi-official Iranian state news outlet. They say the points include a permanent ceasefire on all fronts. They're also saying US commitment not to interfere with Iran's internal affairs, lifting of the US naval blockade within 30 days, and the US withdrawal of forces from Iran. They're saying the reopening of the Strait of Hormuz will take place within 30 days under Iranian arrangements. They don't say what that means. The US and its allies are going to deliver reef construction plans to Iran worth at least $300 billion US dollars, and will end sanctions on Iranian oil and energy products. And there's also a reiteration of Iran's commitment not to produce nuclear weapons, and the US commits not to increase its forces in the region and not impose new sanctions. Mayor's also reporting that final negotiations will not begin before half of Iran's frozen funds are released, Iran's oil sanctions are suspended, and the naval blockade is lifted. So, Mark, I suspect from a market perspective and an investor perspective, all that matters is, are we going to start seeing tankers moving through the Straits of Hormuz? It looks like not immediately, but nevertheless, what is your reaction to this, and what do you expect to see in the markets?
We have to be a little bit, conservative, despite all the optimism that may be implied by the news. But of course, as much as we have to take the news with a grain of salt, I think it's about time. It's about time for people to move on. Not just we, the outsiders, the investors, but also those people who get involved in the war, just like the Trump administration in Iran, and so on and so forth. Basically, the higher than expected crude oil price is going to affect the inflationary expectations so much that the rate hikes expectations are gradually priced in, and all different kinds of asset prices are actually reflecting this fact gradually. And it may not be entirely a good thing because people form a rational expectations of inflation, and that may become a self-fulfilling prophecy because those things that you don't buy at this moment, you're going to buy it at a much more expensive prices. So that kind of a self-fulfilling prophecy and that kind of a positive feedback are going to be set in. So I think it's about time. It's about time for all the parties to sit down to at least try a little bit different because we have been for the last few months, especially ahead of the weekend. Every time the Trump administration has been announcing that there will be good news, there will be good progress, but nothing happened. Maybe it is happening, just not substantial enough for the news announcement. But now I think it's about time.
Okay, well, look, markets are starting to react to that. First of all, oil prices this morning have started, oil has started trading in Asia. Brent crude, the global benchmark, is down about 3.8% at the moment, trading just above $84 a barrel. I mean, Carlos, from an economic perspective, is this something now where the damage that we've been seeing done to global economy, and particularly some Asian economies, can repair very quickly? Or do you think it's going to take a while before we do start seeing the repair to the economies happen and maybe inflation expectations start to come down?
Well, I think that from an economic standpoint, we have to look at it from the perspective of the US and then also Asia. At the very least, if this news turns out to be, it would remove some of the fog in the outlook and provide some visibility. Vis-a-vis the United States, what we are seeing is that most of the drift in inflation has been driven by energy, and there are limited spillovers to core inflation. And that's one of the reasons why the Fed is one of few central banks that hasn't had to hike interest rates. Of course, if the Fed were to increase rates, as some market practitioners are sort of calling for, that certainly could be a risk event that capitulates global equities. And for that is the US is less dependent on important energy from Iran, and also less dependent on fertilizer imports from the Strait of Hormuz. And so as a result, sort of biggest, most liquid, most important market hasn't been as impacted. If this proves out to be true, what we think will happen, market expectation will move very quickly from potentially having to hike interest rates to a scenario where the Fed is in a position to look past a temporary increase in inflation over the coming months. To 4.3% was our sort of expected number over the summer. Already there. If there's visibility that trade is going to resume, the Fed can sort of look past this uptick in inflation, assume no tightening in the labor market, and more importantly, it from the second quarter of 2027 onwards. So this is the best case scenario, assuming the ceasefire is real. Now, for markets in Asia, unfortunately, we are still seeing some spillover effects and second round effects. And fertilizer prices have been impacted in the region. Sulfur prices in China continue to climb, and that is one of the key components for fertilizer. So we do expect a little bit more impact in Asia throughout the third and fourth quarters, so second half of this year. So it means we might continue to see tightening across several key central banks, but hopefully with resumption of trade talks, those rate cuts can be reversed starting from the second quarter of 2027 because there'd be a base effect and then cooling energy prices facilitating that transition. Market understands it in this manner. It should certainly be a development that fuels risk-on sentiment. So we should see gold, we should see oil down, and we should see sustained support for equities.
I mean, Mark, do you change anything from an investment perspective, from your portfolio perspective? I mean, presumably one of the positives is oil, but maybe we're not going to see oil fall back to, certainly not for a while anyway, to the levels it was at before the war started at the end of February.
Well, I tend to be more positive on the near future of the gold prices because of the seemingly negative correlation since the Iran war started. And I think, especially because if you take a look at the later stage, the interactions between the crude oil, NYMEX crude oil, and the spot gold, you can see that despite the fact that oil price is staying around 90 and 100 within that range, and actually gradually shifting down. Uh, Gold price is not immediately affected to rise because of the priced in the already priced in rate high expectations. So it is very important that we don't assume a very stable or stationary relationship between the two. But at least for the foreseeable future, it is quite likely that gold is going to have some kind of rebound, and I think maybe first of all 4,400 for the spot gold. It is the first station, first stop for the resistance, but and I think it is going to be higher and higher as long as Trump administration is not going to do something silly, something stupid to get rid of everything, every potential or progressional success on the way. It is quite likely both equities and gold and most of the things that have been going down in the previous few weeks are going to have some kind of rebound.
Well, Carlos, is this one of those deals where initially it all seems great for markets, but we start to see maybe the costs surface later, and particularly some of the longer term costs of what's been done? I mean, the Asian Development Bank was saying that, this energy crisis for Asia is now at the worst case scenario. They've raised their inflation outlook for the region to 5.2%. They've cut their growth forecast now down to 4.7% for Asia Pacific. Is this damage going to take a long time to heal, and there are going to be some real long-term costs for this?
I don't think 4.7% growth for Asia is the worst case scenario. To answer your question very simply, it is true that we have seen a reversal in the thematics that we saw prior to the Iran war, and a lot of the sort of inflows that were coming into the region have turned into outflows, with investors, global investors, favoring a very specific subset of stocks and the US dollar. Whereas at the beginning of the year, we were looking at inflows into emerging markets, into Asia technology, and de-dollarization themes. And so we've gone from a situation where the market was extremely positive on Asia to a situation where the market is more cautious. And then as a result, you have some investors calling this the worst case scenario for the region. I do not think so. I think the region, from a fundamental perspective, is well positioned to withstand a modest rate hiking cycle. It's true that growth forecasts go from being very lofty to being a little bit more conservative, and we are seeing central bank reaction function working pretty well, I would say. I would say we are leading even the European Central Bank in this round, perhaps because the impact is a little bit more direct on Asia. As you know, 80-90% of the flows end up in China, India, Japan, Korea, and some Southeast Asian markets. So I don't think it's a worst case scenario. One thing that does worry me is whether or not for the coming quarters we are going to see desynchronization or an increased disparity in Asia, with developed markets like South Korea and Japan experiencing exuberance, in many cases led by equities, but also because these markets are rich, they can afford to pay more for energy, and they have more bargaining power in the global stage, so they can access fuel and stuff like that. Whereas Southeast Asian economies, they are not experiencing the same exuberance. Plus, it may be more difficult for them to secure fuel and so on and so forth from the global market. So what could happen is that you have shortages and disruptions in emerging Asia, with the rest of developed Asia booming, but in a very K-shaped manner. So I think that is the risk, but we are not in a recession. And even if things were to take a turn for the worse, the region is better positioned from a fundamental standpoint. No current account imbalances, and no excess dependency on external flows, with the exception of a few very small economies like Myanmar, for example. And so I'm not terribly worried. I'm just concerned whether or not it's going to fuel a little bit of inequality in the region and how that pans out in the future, but not worst case scenario for growth to be 4.7%.
Okay, well, that's good news. You've mentioned central banks. Let's talk a bit about the central banks, because it's a busy week for central banks. The Fed, the Bank of Japan, the Reserve Bank of Australia, the Bank of England, all meeting. Also out here in this region, Taiwan, Malaysia, Indonesia, and the Philippines central banks all meeting. Let's talk first of all about the Fed, Mark. This is Kevin Walsh's first meeting. I have no doubt that Donald Trump is going to be putting pressure on him now that this deal is signed to go and cut rates. He'll be saying that oil prices are going to come down pretty quickly. That means lower rates. But I presume, Mark, the Fed is going to resist that.
Well, of course, Donald Trump is going to have some kind of influence on the new Fed chief, but I think, but I think it is not quite likely that the so-called professionals, the central bankers, the technocrats, is going to follow the orders, the instructions directly, because it is not quite appropriate, not just for its own sake, but also for the best interest of every party, including Donald Trump. I think it is most likely to adopt a kind of a wait and see approach, because in the past few weeks, or if not months, the inflationary expectations have set in, and so much that the rate hike scenario has become more and more relevant than the rate cut scenarios. So it is very hard for all the Fed officials to argue against each other. It's better for him, especially because it is the first meeting, first FOMC. I think it is quite important for him to have that kind of leadership to be gradually built, and it is more likely to be just no change to everything, just then wait, just to show some courtesy and to be polite to everyone. I think it is the best way for him to build maybe not friendship, but at least not a lot hostility.
Okay. I mean, Carlos, no one realistically expects the Fed to cut rates, but markets are pricing in a more than 50% chance of a rate hike before the end of the year from the Fed. Do you think the markets are right on that? And if they are, I presume that the Fed pretty soon is going to have to change its bias and have a bias towards raising rates.
We think the market is wrong. So,
it's happened before.
Yes. So, assuming the ceasefire does materialize and we see resolution to the situation in the Strait of Hormuz, the conditions are not there for the Fed to hike interest rates quite yet. The bar for them to hike remains high in the short run. So domestic demand is quite strong, and the labor data, as we saw last week, looks more solid. But for them to hike, we need inflation expectations to de-anchor, which isn't the case yet. Medium-term inflation expectations are still sort of around the Fed's new tolerance band of 3%. Or we would need real rates to fall significantly, or we would need the unemployment ratio to decline significantly. Currently, it's 4.3, which is below the natural unemployment rate, but if it were to go to below 4%, that would really show tightness in the labor market. And of course, that tightness is a reflection of both strengthening the US economy and Trump's policies on immigration. So it's not entirely, demand pull. But we think those conditions haven't been met yet. So assuming there's no overshoot in inflation that pushes real rates down or like a massive strengthening in the labor market, they can afford to look through the temporary increase in inflation. And then what will happen is once inflation starts to cool or normalize in 2027, that's when Warsh will have a window to deliver his rate cuts for Trump. So we think that scenario, the possibility of that scenario is still higher than that of a rate hike. But it all hinges on whether or not we have visibility as to what happens in Hormuz. So this week, it looks very positive and promising, but we don't know if that's going to be true or not.
Okay, well, let's also talk about the Bank of Japan. Mark, they're starting their two-day policy meeting today. They'll deliver their decision tomorrow. Markets are increasingly expecting now that finally the Bank of Japan is going to get on with it and raise rates. Are the markets right, or are they going to be disappointed?
BOJ, we all know that in the past few years has been very actively pursuing the normalization, or you may say renormalization of the monetary policy since the financial tsunami, the QE's environment, the ultra low interest rate environments, to make everything positive, including the interest rates, including the inflation rates, everything. I think, of course, we know that it is the bigger picture, the goal and the target. But it is I think it is not easy. It is not easy for the Fed, for the BOJ, the officials to decide on the things. We have to be realistic. Even the BOJ chief has mentioned before that as long as there are problems, some kind of conflicts or contradictions, they are going to listen not just to monetary policy, but also to what the government, the Japanese government, is going to say. But we all know that the Japanese government had to coordinate with the Trump administration to a certain extent. So it is not just the BOJ chief as technocrats can decide once and for all. So it is difficult. But of course, we know that it is the goal, it is the target, it is the. But we are not sure about the timeline. At this moment, I think it is quite likely. Maybe they can take the initiative as long as the ceasefire is assumed to be realistic. They're going to do something at this moment, knowing no one is going to fight against it. Maybe it is a good timing. Other than that, the window will be narrow and narrow.
Okay, Carlos, there's a complication though, isn't there? Because Governor Kazuo Ueda is hospitalised, so he's not going to be able to take part in this week's monetary policy meeting. Does that complicate things for the BOJ, particularly in terms of how it communicates what it's going to be doing? Because the currency markets in particular are really hanging on every word from the Bank of Japan at the moment.
Okay, I think I look at Bank of Japan from two perspectives. The first one is whether or not they need to hike. And if you look at the data, it appears that they are slightly behind the curve. So you do have the 10-year break-even rate at around 2.5%. And the 10-year inflation expectation, 1-year inflation outlook, according to the Bank of Japan Tankan survey, is 2.6%. So both sort of medium-term inflation sort of proxies remain above Bank of Japan's 1% target. And if you do the Phillips curve analysis, with a structurally tight labor market and inflation expectations remaining high, it does appear that the Bank of Japan is quite a bit behind the curve, literally. So we do think that with real rates remaining negative and then all of these sort of technical indicators point to the need for at least 50, if not more. Phillips curve actually says 75 to 1. I think that's a little bit exaggerated, but with all of these indicators pointing towards further rate hikes, there is no question that Bank of Japan needs to do something either in June or in July. Now, my sort of view was that it would happen in June. What Takaichi has been quite aggressive in terms of delivering fiscal support, and these measures have been predominantly targeted at reducing the cost of energy and food for households. So they've introduced subsidies, and they've also considering to cut the food tax. And so as a result, there's been a temporary cooling in CPI prices, and that temporary cooling in inflation may have given Bank of Japan a window to delay the hike to July. But to your earlier point, if anything, I think Ueda being in hospital shifts this earlier to June because he will have submitted his recommendation. But the prospect of a divided monetary policy committee is worse than just delivering the rate hike while he's in hospital. So I think if anything, they may actually do it in June rather than July to avoid any pitfalls or any potential disagreements that might look messy and trigger some panic in the market. And moreover, I would say that they have room to do one more rate hike either in the fourth quarter of this year or the first quarter of 2027.
Okay, another market I want to talk about with you both and economy, South Korea. It's been a busy week, Mark, isn't it, for Asian markets? But once again, South Korea, the Kospi leading the way. It was up 4.6% Friday. For the year to date now, up 93% this market. Had been up more than 100% at one stage. But people are getting a bit concerned about how much, first of all, this is dependent upon just two stocks, Samsung Electronics and SK Hynix. We've got reports that banks are sort of tightening up their lending requirements for buying stocks like SK Hynix and Samsung because they now account for 53% of the Kospi. What do you see going forward for South Korea here? Because by any stretch of the imagination, this is a rally that, you know, for 2 years in a row now has doubled the market. It's quite extraordinary, isn't it?
Yeah, sure. I think it is quite likely that the so-called correction, or at least some kind of selling pressure, is going to sustain a little bit because quite a lot of people, not just the local investors, but especially the foreign investors, they have been quite bullish on the whole thing, not just for its own sake, but for the whole AI and also the tech frenzy. And I think it is, to a certain extent, it is justified because we have to find different competitors, different sources of suppliers for different things. And basically, the whole clash between China and the United States on that kind of arms race, so to speak, is to be hinged on. And I think it is very important for investors to try to locate different opportunities. But as you said, the rally has been sustained for so long. It is quite likely, I think, at least for this moment, after the IPOs of some super giants to a certain extent, it is quite likely that more correction is on the way, at least for the coming few weeks.
Carlos, the economy, it's booming, isn't it? It was up 1.8% quarter on quarter in the first quarter. Year on year, it's up 3.8%. This looks like an economy that is really benefiting from the AI boom and obviously having companies like SK Hynix and Samsung Electronics that can benefit from that.
Yeah, correct. I think this is already a headache for the Korean government. Because we have an economy that has become increasingly dependent on semiconductors. It is about 25% of its total exports, but if you look at the contribution to GDP growth last year, it was like 60% or something ridiculous like that. So it's fueling narratives of a K-shaped recovery. For the first quarter alone, granted, we are not expecting performance for the year to be 3.8% year on year across all 4 quarters. but we saw extremely lopsided performance. So manufacturing expanded 7.2% year on year, and it was 3.9% quarter on quarter. And of course, a lot of that was fueled by semiconductors, with semiconductor exports up roughly 170% year on year, which is massive. Where I am not sure about the rally is because these companies are providing forward guidance that they expect demand to exceed their ability to produce chips, and that should fuel robust double-digit profits well into 2027. So for me, I think the Korean economy will remain quite dependent on semiconductors for the next couple of years. But it is a problem if there were to be a huge correction because the market is so dependent. But the problem from a macro standpoint won't be whether or not the price of these two semiconductor stocks cool. Yes, it is true that there's been a lot of retail invest flows into the Korean equity space. And leveraging is at an all-time high. So you have retail investors that are taking on debt to invest in these stocks. So if there were to be a big correction, the wealth effect would affect consumption, but consumption is not the main driving force. It is helping at the margin, but the main driving force is this physical manufacturing and export of these goods that remain in dire shortage globally. And I think this global AI infrastructure build out is going to continue to support the Korean economy. So that's why I do think that there's upside risks to the consensus on the Korean economy. We are expecting some cooling over the next quarters, but growth should be quite high at 2.5%. And what happens is then you have a bit of a lopsided situation in the labor market, which means that workers that are involved in semiconductor manufacturing and related industries are demanding higher wages. So Samsung is one clear example where their employees actually threatened to go on strike unless they got higher wages, and Samsung sort of conceded and increased wages. But people working in the service sector, for example, they are facing pressure. They don't see wage growth, and as a result, you have widening income inequalities and a little bit of social unrest. So that could materialize into some election losses during midterms in Korea, or even more protests. And so, remember that just a couple of years ago, the Korean equity market was doing terribly. There was a lot of discontent with the leadership of the Korean government, and there were mass protests on the street. So I'm not saying that we will get there, but the longer that this situation drags on for, the more likely it is that in a couple of years we will see real disruption and political instability. So, near term, I'm not as worried, to be frank, because the earnings are so strong. But second half of 2027, 28, I'd be more worried.
Okay, well, look, I'd love to talk more about some of these things, but sadly we've run out of time. You heard there Carlos Casanova, who is Senior Asia Economist at Union Bancaire Privée in Hong Kong, and also Mark Toe, Managing Director of Asset Management at the Fung Financial Group. As it's a Monday, it's time for our regular view from mainland China, and I'm joined this morning by Andy Sher, Shanghai-based independent economist. Morning, Andy.
Good morning, Peter.
Let me first of all get your reaction to the big news of the morning, and that is this reported peace deal between the US and Iran, which will allow within 30 days the Straits of Hormuz to reopen and goods to travel unimpeded through it, although we haven't got all the details yet. What does this mean for China and China's economy?
Well, China imports roughly about over 7 million barrels through the strait. It's been cut by half. China is being importing 3.5 less in the region the last couple of months. So obviously, it will be good news if it's implemented. The China doesn't have to draw down the reserves, but I'll be cautious. I'll be really cautious.
And cautious because you're not sure that this deal is really going to hold, or we haven't really seen the full details of it yet.
I think the odds of the deal holding is really low.
I mean, China has really done very well, hasn't it? In given what's happened to the global economy, it's reduced its dependency upon oil going through the Straits of Hormuz. It's cut back by more than 3 million barrels a day of oil imports, and it hasn't really affected China's economy. It's drawn down its reserves, but nevertheless, it has held up reasonably well, hasn't it?
Yeah. I think in the last couple months is really held up really well. Partly because of this AI boom or probably bubble, it's led to huge demand surge in for equipment made in China. You look at all these data centers. No, only the chips are made in Taiwan. Everything else mostly made in China. So that's why Chinese exports are really surging. But I think that when the war goes on, obviously the oil price will likely be much higher. So far, China and the United States have offset over about 2/3 of the decline in the oil supply by drawing down their reserves.
Do you think this can go on? You said maybe this might be a bubble in AI. Do you think that's the risk, and that China might not be able to rely on this for too long?
I think every bubble bursts, but we never know when it will happen. As long you all you need to do to look at the stock market. As long as the stock market gives these huge, incredible prices to all these companies that probably will never make money. The boom can continue. So it's really you need to look at the stock market.
Yeah. Yeah. What about China's exports sort of overall? I mean, they are still holding up incredibly well, aren't they? The exports jumped 19.4% in May from a year earlier. This is despite the troubles with the global economy, despite a slowdown elsewhere in the region. And in particular, once again, persistent demand for semiconductors, AI hardware, that really seems to be supporting sort of exports. How sustainable is this, first of all?
Well, I think China has diversity and depth. So these would have we have seen over the last 10 years, despite of all these crises. And I think that you look at always something happens, something pops up. Not just the AI equipment. You look at the renewable energy part, partly driven by the crisis in the Middle East. It's really surging. The some of the solar up close to 100%, and EVs exports are really surging. So I think that what's going on is that China is, basically has all the bases covered. So whenever there is some sort of a boom in demand somewhere, and it trickles down, it comes to China for supply. So this is where, as long as the global economy is doing okay, China will be doing okay.
But the trade surplus is widening, isn't it? To the US, the trade surplus, $105.5 billion in May. Sorry, that's the overall trade surplus. The trade surplus with the US climbed to $26 billion in May from $23 billion in April. This presumably is going to cause problems, isn't it, with China's trading partners in the US, but also particularly in the EU, where they're very upset about these big surpluses, and they're saying that it's just unsustainable.
Well, I think that the problem is that there's an AI boom, and they are buying stuff from China, and China is not buying. They don't have stuff that China wants to buy. So the story that between the United States and Japan in the 1980s, we're seeing it now. So I really don't think that. There's a solution to that. Having said that, overall trade surplus is declining a little bit, mainly because due to the surge in oil price. China is buying less, but is paying more.
But you say there's nothing that China wants to buy, and everyone wants to buy China's goods. There must, I mean, the EU is a huge trading bloc, isn't it? 20 countries. It's one of the biggest trading blocs in the world. There must be something that China can buy from the EU. Surely it can't be that there is nothing whatsoever that China wants to buy.
Well, you look at EU, they have luxuries, they have automobile, they have equipment. And in terms of automobile, that's a huge swing factor. Basically, the European companies are really struggling in China and even elsewhere, competing against Chinese companies. This is like a huge phenomenon. In the last 5 years, China has become so competitive in the automobile sector. So that's I don't know how this problem can be this can be resolved. But China's competitiveness in the auto sector is continue to surge. So there will be further negative impact on the demand for European cars. And then the other is the equipment. A lot of equipment they don't sell, like the ASMO's lithography machine or some of the other machines. And then the problem is that China is trying to make the machines themselves. We have already seen that in many areas. Once Chinese learn how to figure out how to make these machines, not only they buy themselves, they sell to somewhere else. Then the Europeans cannot sell. So the only thing that they do have an absolute advantage is in luxuries. So in absolute luxuries, China is now, its demand is still there, but it's not like before. It's retail. Retail has been around 2% so far this year. We don't know the number for May yet. But we after the property market began to decline, we do see that retail is not so strong. So it takes many years to recover.
Well, that's what the EU says is that it's not that it hasn't got products it can't sell. It's that it's competing, first of all, in sectors where China is selling goods below cost, like in solar panels, and in other areas like cars. Chinese companies are receiving massive sort of subsidies, so there's huge overcapacity with not enough domestic demand. So that's all being put onto European markets. Do they have a point, do you think, there?
Well, I really doubt it. You look at EV, and even the consumer subsidy used to be like most countries have that. It has been cancelled. Even the subsidy in sales tax, 10% sales tax, last year was still there were 10% all exempted. Now this year is only half. So I think that the issue is that the Chinese car factory, based on these the some of the consultancies studies, in terms of physical productivity, that how things move, how fast they move, much more efficient, like a 30% more efficient. It's that it's just at the factory level. Then we have on the parts part. The China's supply chain is very complete, and it's got a scale throughout the supply chain. There's a tremendous economy of scale, and you have these new technologies that being used like gig casting and battery pack and so forth. We see innovation in terms of reducing cost. And you look at it, the cost difference is so big. It's not like Chinese cars need government is giving some money so they can climb over the water. In China, cars are selling at half of the price or less than in Europe or in the United States. It's not like like Japanese or Koreans. They used to sell cars in Europe cheaper than at home, so they were subsidized by their own consumers. In China, it's the other way around. Chinese car companies, they want to go abroad because the prices are high there and they can make money easier than at home.
Well, the EU says it's now going to consider laws that will require firms to adjust their sourcing if more than 40% of key inputs come from a single country. Now, the EU is not singling out, it says, any particular country, but for sure it must mean China there, mustn't it? That's the target. So what is that going to do, do you think, first of all, to the ability of China to carry on selling into the EU and also to EU-China relations overall?
That is in a way old story. You look at what the EU has been saying, has been doing. It's like they have become more dependent on China. So this is the story, and some companies they had this China plus one strategy. They tried to move to Vietnam and India. No, India's story has been a disaster. It's a catastrophe. You look at probably like everybody before this wave, they will lose their shares. But in Vietnam, it's kind of skin deep because it's still dependent on materials and the parts from China. You have basically assembly there, and Vietnam doesn't have the depth to build a complete industrial supply chain. It's just not possible.
So will China retaliate, do you think, if the EU tries this, or will they just sit back and see what happens? Because from what you're saying, if the EU doesn't buy from China, it won't have complete supply chains, and it won't be able to sell the products because it won't be able to get the inputs that it needs from elsewhere.
Yeah, if they ask the companies not to buy more than 40% from a single country, I don't think China will react. But if they have like policies of asking companies not to buy from China specifically certain products, then there will be a reaction. So I think that it's just China doesn't need to react. But it sometimes needs to react because you cannot look like you're being pushed around. But the bottom line is that the EU is very weak. It's getting weaker. It's getting weaker. Okay, after the Ukraine war began, a lot of German companies have moved to China. A lot more, like in chemicals. They basically have moved away from Germany because they couldn't get energies from Russia, so they came to China. The irony is that Russia is increasing supply to China like gas, so they coming to China for Russian energy. So I think that EU story is kind of tragic, and the US story at least has some logic because the US wants to weaken China, or the US wants to maintain its hegemony in the world. But a lot of other countries that how they react, it's puzzling. You look at Japan, it's the same story. They're doing stuff. They're being aggressive for no reason because they are not in a position to be aggressive. Why are you doing that, right? Then they're hurting themselves, and then they're becoming weaker and weaker. Then they go bust. And the U.S. is not going bust because these guys are going bust first, and the money is heading to the U.S. despite it's a huge trade deficit. So that's the tragic story of Europe. Europe is not that important anymore, and the people in Europe don't understand that.
That's Shanghai-based independent economist Andy Scher.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning. Do please take a look at my daily newsletter. That has more information on some of these important topics we've been talking about this morning. You'll find that at peterlewismoneytalk.substack.com. On Tuesday's show, my guests will be Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Peter Kim, Head of Global Investment Strategy at KB Financial Group in Seoul, and in Washington, D.C., our US economics correspondent, writer and broadcaster, Barry Wood. See you tomorrow.
Money Talk